I'm kind of focused on this Deutsche Bank piece, which I think is a great job of analytics, and it's a sort of great way for investors to think, which is there are three things out there. How do we measure their impact? And then what you have is, and then the real problem is the cumulative effect of all three, right? And to your question, Scott, I'd say very simply that if you, we can probably withstand a hard Brexit, and it would hurt, but it wouldn't be calamitous for us. We could probably withstand a growth recession in China. But the idea of the trade war on top of all those three things, that's when I think it's time to get worried. And who was it yesterday? It was somebody was saying yesterday on this show that they believe that cooler heads, it was Jim. He was saying, look, it's so bad to have that trade war is so that he thinks that they will definitely back off on this trade war.
So to your point, what you're saying about this note, again, that we were focusing on, Deutsche Bank says the world economy, if all of these things happen, the world economy could face a downturn rivaling that which occurred during the Great Recession a decade ago. I mean, that's the doomsday scenario.
I think that's overstated. I think it's overstated for a couple of reasons. When you guys were talking earlier about the tools that the Fed has, there are a lot of tools. You guys remember the PDCF, the TILF, all these things they had. The Federal Reserve and I think other central banks around the world.
And most people don't know what either of those are.
I'm going to explain all you need to know, which is a way to backstop critical parts of the financial system in ways they didn't have before. The commercial paper market, the money markets, they have an ability to stop that cascade. I don't think they can stop economic outcomes from where they're going to be, but I think they have the ability now to stop a spiral inside the financial markets, which made the Great Recession great.
They do, and I agree that there are lots of tools that the average person doesn't know. But the primary tool is to push you into risk assets, right? And
that's an important one, yeah.
Right, and that's lowering rates. So we've had free money, one of the things.
Or QE.
Or QE. Yeah. But we've had free money and QE for such a long period of time. I don't even think
are you wearing a microphone?
It fell down.
All right.
What is remarkable, in picking up on what Stephen is saying, is that we are back in a place where we need easy monetary policy to save the markets once again.
I mean, this is a simple question. Are we underestimating the risks that Deutsche Bank brings to the fore today?
I think that the trade situation is the linchpin that can create that scenario. However, I don't think we're in a situation where the financial system is in crisis the way that we were in 2008. And so I think that we're moving into what is a more traditional recession of production and consumption being, a supply and demand mismatch.
And let's say if you don't, Josh, believe that you get the doomsday scenario, or as Steve suggests that some of the risks here are overstated, neither of these three, and certainly taken together, are good for risk assets, i.e. stocks.
That could
Even if it doesn't get to the lowest point of where this could possibly go.
There's a lot in between 2008 systemic global financial crisis and just a run-of-the-mill slowdown in markets and economies. Keep in mind, that's coming from Germany. Nobody does doomsday like Germany. Look at the philosophers that they've produced. Outstanding, outstanding, but not great if you're allocating a retirement portfolio, for example, to be focused on the three doomsday scenarios that are tapping us on the shoulder. I think it's interesting to look at Deutsche Bank as a source of doomsday. Here's a stock that is down 50% over the last year, while the European banks are down 22%, and Europe in general, just European stocks, are only down 10%. So you could make the argument that the Bund yield threatening to go negative again, Deutsche Bank threatening to need some sort of either a bailout merger with Commerzbank or something worse. Why don't the Europeans focus on what's going on with their issues and not project that at what's going on with the U.S.? That would be a good first step. And then when you think about a company that had a market cap shrink from $50 billion down to $12 billion in just 3 short years, that is a source of downward pressure on low rates. That is a source of deflation being imported into the United States to some extent. That is what's pressing down. And so European consensus growth over the next year, a couple of months ago, they were talking about 2%. Now it's like 1%. Does that go to 0%? You want to buy stocks if that's the case? I don't know.
Okay. Can I go now?
The dude abides.
Thank you. Okay. So if you're pinning your hopes, right, on this rally continuing, or who knows, even, approaching or sniffing new highs, you can't have any one of these outcomes happen. You can't have a significant and lasting slowdown in China. You can't have a hard Brexit. You can't have the trade tensions devolve to a point where you get a mild recession in the U.S.
I don't think that's right, Scott. I don't think.
How is the market going to withstand any one of those three?
I think you got to parse things out a little bit. The business cycle has not been repealed. There's going to be business cycles. It's entirely possible that you have a slowdown after what is something like 10 years of expansion. That can happen. And it's interesting because what we know about economics and psychology is that people think that the thing that happened last time is the thing most likely to happen next time. Because we had a great financial crisis in 2008, everybody thinks the next downturn is going to be a crisis. It's not built in the cake.
I don't think that's true.
We can have a downturn that doesn't have the label crisis on it, that has the level recession on it. And we could go through a cycle where some stuff is shaken out. You don't have a massive. That's possible. What I'm worried about here is the things that are so-called man-made things, the trade issue. And I do see finally, by the way, business pushing back a little bit on the Trump administration. If I could go on a very short riff here, give me 30 seconds, which is the Business Roundtable is now backing a bipartisan bill to limit the president's powers to impose tariffs on national security. I think this is a very important pushback by business, which is saying enough of this. Don't give me tax cuts over here and take it away with trade fights over there.
Okay.